if you've known me for some time, you know that I like to do stats over how well do these zones perform, not just as a measure of how many dollars can be made on the trades, because that involves filtering using the high time frame rules and other rules, but just raw stats that say how many of the zones found by SD zones with a given preset give us a one-to-one move or better before they stop out. And the reason for that is that if you get a one-to-one move, the zone could reasonably have been argued to work enough that you could have tightened your stop, you could have broken even, or you could have at least managed the trade, whereas there will be a certain percentage, of course, that just never even give one-to-one, and those I say they don't work. But the ones that give us one-to-one or better, I say they do work. And the last time I sent out some statistics was this spring, along with the article, they buy the dips or sell the rallies article. And let me just pull that open for you, and then I'll show you some of the latest on the ticks intervals. Just give me a second here. So these are the stats I included in that buy the dips or sell the rallies article back in April of this year. And it was an extensive series of performance tests made on 3-minute, 5-minute, 15-minute, 16-minute, and 240-minute intervals in all these different markets that you are familiar with, that we are trading. And again, the way I measure them was I have a automated strategy that trades every zone on the chart that is found for with a one-to-one target. It has a 5-tick stop buffer plus a little extra if ATR is very tall, is very wide at the time, and no break-even stop. It's just it either gives me one-to-one or it stops out, and this then measures how many of them actually were winning trades, how many actually gave us one-to-one. My core benchmark is over the last 20 years in the ES 15-minute, and that one has hovered around 70%, sometimes been a little higher, other times been a little lower, so that varies from a 1 year to another, but it also of course varies across different time frames and different markets. That goes without saying. One thing that's important to point out is that because the stop buffer is fixed at 5 ticks, that means as you get towards smaller, lower intervals, that means you're going to have a higher win rate because that stop buffer is going to be relatively larger. And as you go to higher intervals, that stop buffer is going to be arguably too small, and you will have a lower win rate. So the sweet spot kind of for that 15 for that 5 tick is in the somewhere 15 to 30 minute range. That's usually where that is a comfortable stop buffer. So that's something to keep in mind. Something else I want to point out for those who know about TradeStation, this is measured looking inside the bar back testing, where it's counting it on 1 minute bars. So it's using 1 minute bars to actually make these trades and measure how they perform. One thing that may jump at you when you look at this 12-month period from April 2024 through April or into April 2025, that 12-month period actually underperformed the 20-year performance, where we had a 70% win rate, and we only had 62%, so that's quite a significant underperformance during that period. So at least as far as the ES 15-minute goes, that has not been the best time for supply and demand zones in ES futures. It does vary with the different markets and different periods, but that's something to keep in mind. So if you have found it a little harder to find good trades during that period, there is a reason for it. That the market has been a little different. It has been more erratic in many ways, as we have found. That said, some markets and some intervals actually perform very, very well, even during this period, where the ES was struggling a little bit to keep up with its 20-year average. Let me scroll down and you'll see what I mean. For example, looking at the bonds, not the James bonds, but the treasuries here, 10-year and the 30-year. On this one, the intervals are a little bit different because trading 3-minute and 5-minute and 10-minute in those doesn't make sense at all. If you look at that chart, you'll know what I mean. It's just they're way too coarse for that. So the lowest I've measured here is the 15-minute. So I measured 15, 20, and 30 and 60 instead of the rates we saw, instead of the intervals we saw in the other markets here. And actually, you'll notice in the new workspaces, I actually cut them off at 30. I don't even want to look at anything lower than 30. I don't want to waste processing time on anything lower than 30 minutes in the bonds. But nevertheless, let us then look at 30 minutes. So 68% win rate over that 12-month period, 76% win rate in the 60-minute. That's very high. If you go to the 30-year, it's 77, 60. Very good numbers. But wait, why are we not trading those all the time? Well, because there aren't that many, right? Look, 59 trades all year, 74 trades all year, 77 trades, 77 trades. These zones are rare, but when they are there, particularly in the higher time frames, they work very well. That's why you should look for them, and they are not included in the text workspace, but they are included in the minutes workspaces for swing and Excel swing in particular. Don't overlook these. When they're there on these higher intervals, they work very well. Some other markets that also were outliers and worked particularly well were, let me scroll down, you can see it, were oil and natural gas, pretty good, particularly in the lower time frames, 15 and below. So they outperformed actually their 20-year average in that, both oil and nat gas. Then pretty much all of the metals do pretty well, except gold. Okay, everybody loves to trade gold, and as a matter of fact, when it comes to supply and demand, they stop out more than the other more than the other metal markets do. But look at the other ones here now, 64%, 68%, 68%. So those are close to their 20-year average in these markets. Same thing in copper, also looking good, except there's a bit of a drop when we come to the lower time frames, the lower intervals. Platinum is the same thing. And then generally, you will find that the currencies work very well, and some in particular, such as the yen, has very high win rates. The British pound has very high win rates. So these are definitely markets that are worth looking at. But obviously, for each of these markets, you need to develop some experience. You don't just go in and plunge, put down your money and hope to get rich. You have to practice them for some time, maybe on sim, and get good with it. And obviously, that is very much true with tick trading as well. You do want to go on sim for a period of time, or at least with very, very low position size, to make sure you have a feeling for what you're doing before you start committing your money to this. Ahead of this release, and as part of my tuning of the new zone criteria preset for ticks, I actually made extensive performance measurements in these various tick intervals in all the markets through the month of November, 6 months back. Now, you may wonder, why only 6 months back? Can we please have 20 years back? It's not possible. TradeStation will not give you more than 6 months of tick data. In this case, I even had to stretch that because I made these measurements while I was in December, but I had actually saved my cash from earlier, so I was able to go back and make these measurements. Even then, TradeStation will only measure, in some cases, a couple of weeks at a time. So each of these all have to be measured individually and put into this table here. So there's a lot of work to measure these, but the numbers look excellent in many cases, and often outperforming the minute-based charts we have for the same period. So here we are. Do notice that here we have the lowest intervals to the left and the highest intervals to the right. So in the case of ES, 1500, 3000, 4500, 6000, 7500, and so forth and so on, with all of the different other markets here. Some markets are rather obvious positive outliers, and some markets are rather obvious negative outliers, such as if we compare the 1500 tick ES interval, which is the lowest, the base interval we have for ES, 1200 trades over a 6 month period with a 70% win rate. That's pretty good, even though still 5 ticks may be a little bit on the high side, so that skews it a little bit, but still nevertheless. But then compare that to and that is comparable to the NASDAQ. Its base interval, 1,600 trades, only 57% win rate. So there's something to chew on there. The Russell and the Dow a little bit in the middle of that field, but still, there's no doubt who the winner is among the equity indexes when it comes to tick trading. Other positive outliers, as we scroll down to the other markets, are, well, our friends oil and nat gas. Look at that, right? Nice numbers. Silver, okay, fair enough. Gold, not so much, but not bad either, just not quite as much as the other metals as before. Again, copper, quite nice. Platinum, not so much in the lower markets, and that may be because it's just a thinner, lower liquidity market. Actually, it doesn't perform very well on tick charts on any intervals, so that's something to keep in mind. When you come to the currencies, they all perform very well again, as we saw also in the time-based charts. So again, keep that in mind when you are selecting trades based on these. When you download these performance measurement spreadsheets that were part of your release email, you will find that there are actually two tabs in this one here for the tick intervals. One is for numbers for the new preset 5, the entry zones ticks preset. The other tab is for entry zones strict, the classic preset that we've used all along. And so you can compare the two. And you will find that largely, mostly, the new preset performs better on tick intervals, but has about maybe 30% or so fewer trades in most cases. So that's just something you can balance there when you select what you want to trade. The last thing I want to point out with these performance stats is that they are based on trading all zones, no filtering, right? So when you saw that we looked at the high time frame chart, did we have the right preferred direction? Was it moving in the right? Did it have enough room to go? None of that is factored in with this. This is just measuring all of them, how many gave us one-to-one. You should be able to perform quite a bit better if you do a good job with your filtering, of picking the ones that will not only give you one-to-one, but give you 2-to-1, 4-to-1, 6-to-1, 8-to-1, and so forth. So this is just your yardstick for which markets should you prefer, and which intervals should you prefer in each of these markets. That is what you want to use these performance stats for, and I would say also to give you confidence that this stuff works.